I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, tech earnings start with a spark and then a thud. Netflix delights Wall Street. Meanwhile, IBM fails to deliver. More on the earnings parade, including next week when Amazon, Tesla, and Microsoft all report. Plus, not the police. Facebook CEO Mark Zuckerberg defends free speech on the internet at Georgetown University on Thursday. We'll have more on his appearance, plus reaction. And the Huawei perspective. We get thoughts from the Chinese telecoms carrier business group CTO on 5G, security concerns, and more. But first, our top story. IBM fell as much as 6.5%, the most intraday drop since October 2018. This comes after posting the fifth consecutive quarter of shrinking sales, as weakness in the global technology services segment limited strength in the company's Red Hat business. To discuss, I'm joined by IDC President Crawford Del Pret. So let's start with that top line decline. Was there not enough growth from Red Hat to offset the drop in that core business?
Yeah, so frankly, it's kind of, I think this is a question of one word, which is expectations. I think there are a lot of expectations around Red Hat. They paid a lot of money for the company kind of going forward. But if you look at IBM's core business, they are managing it for profitability as best that they can. But the GTS segment, the sort of global technology services segment, that's a segment that's historically been a profit driver and a cash cow. But you got to remember that as people build these hybrid cloud infrastructures, as they move more to the cloud, their needs in the technology, in the core technology services space, those change. So what IBM's going to need to do is they're going to need to drive efficiency in that area. They're going to need to automate where they can, deploy technology that allows them to frankly have less cost in that area so that they can stabilize that part of the business. Now, to say stabilize is kind of, it's an overstatement. It's not like that business isn't stable. It's just that that business wasn't able to grow in revenue terms.
So you mentioned how expensive Red Hat was, $34 billion. When and at what point do you need to see those synergies start to filter through to the bottom line? Is that a 2020 story?
Yeah, I think it is a 2020 story, but I also think if you look closely, we're starting to see it now. You saw Red Hat post 20% growth. So what that means is that you've got a Red Hat product that you now put through this vast IBM sales force, this vast IBM machine. And if you look at the move to hybrid cloud. So in one of our recent surveys, what we saw is that, you know, a meaningful set of large companies have a cloud strategy. They don't necessarily, they have a sort of best fit cloud strategy. They have a cloud strategy where they're going to be some in the private cloud and some in the public cloud. And that plays to the Red Hat strategy. So what IBM needs to be able to do is enable these hybrid cloud customers, be out there and accelerate growth for that business. We're starting to see that. I think you'll see that going into the first half of next year.
I want to come and take a look at a chart that I'm showing in our terminal for our customers here, which basically, you know the story. It is software versus hardware, and you have the big outperformance of software here relative to hardware, and then the gap between the two has really expanded. Software in white, hardware in yellow. Does software now, though, look overvalued given the big run-up?
Yeah, so we don't do sort of buy, sell, hold recommendations here at IDC. What I will tell you is that the expectations are really high for software. Now, we've seen software continue to accelerate. We believe that software revenue growth for the overall industry for the next couple of years will be between 8 and 10% annual growth, and that's really steady and fairly predictable. What's changing about software that I think people are starting to understand in that chart is that it is a subscription business, so it's becoming incredibly predictable. Hardware, while some companies like, say, HPE, are trying to go to an everything as a service and sell hardware as a service, we're at the nascent innings of that. But software has been being sold as a service for over a decade now. So that means predictable revenue and you can see out as a management team very, very far in terms of what your revenue is going to be as you sell those subscriptions.
So is that recurring revenue the focus on software, meaning you're focused on the top line, or is it also filtering through into an increased focus on the bottom line?
Well, depending upon where the company is in its maturity, you obviously at times times are always focused on that bottom line, but in the very, very early stages, you're less so focused there. What you're focused on that business is bookings. You're not even focused on revenue, you're focused on bookings, being able to sign new contracts that you know will be a subscription revenue that they'll be earning over the course of the future couple year period. And that's really what you want to focus on is bookings.
We've seen some good public success stories in the IPO market. Zoom, Datadog.
Yep.
Now, though, they're at 26 times enterprise value to forward sales.
Yeah.
Why are you still think that those are good stories despite that high valuation?
Well, so people kind of know what they know. And what they do is they go back to the 2000 timeframe and they say, here we are, it's a bubble, it's crazy. I would argue what's different is that these companies are solving really, really hard problems, whether those problems are around collaboration, whether those problems are around application management in the cloud, whether those products are solving products like incident management. So what you find is that when technology moved into the cloud, everybody thought, well, there'll be no need for any of these software products any longer because we'll just be operating in the cloud, and Amazon or Google or whoever will have all those, and will capture all that revenue. The truth is that a lot of the same problems exist in the cloud. I have to be able to manage my applications. I have to be able to manage my data. I have to be able to migrate my data. I have to be able to figure out, do I have the right application for the right workload? How do I respond when there's an incident? Because guess what? When I'm in the cloud, my entire business will go down if that cloud application goes down. So the problems are there. These guys are solving real world problems. And what I believe is that over time, you'll see that these companies create long-term value.
So calls about the market being overvalued, toppy, dot-com era bubbly, you believe they're unfounded?
I believe that these companies are solving real problems, and these companies will create meaningful value going forward. Tactically, it all depends on kind of where you are in the cycle, but these companies, I think, are creating value long-term.
I want to end on just sort of broadly looking at the U.S.-China trade war. We thought last week there was a little bit of a resolution, but we haven't really gotten a firm line. How does that play out in the market?
Yeah, so in the tech market, the way that plays out is that we saw relatively small impact in 2018. Going into 2019, we saw a tariff list that's been really crafty in terms of how it's been constructed, and we're seeing that the sort of as the things that are on the tariff list get pushed out, we're seeing relatively small impact. However, if we do end up enacting that list, you'll see smartphones be affected, you'll see PCs be affected, and we think that could cost us anywhere between 0.5 point to 1.5 points of growth in the market going into next year.
1.5 of growth.
That's so that would take us down from 4% to say 3% overall growth, and that's kind of the scenario we're working with in terms of total tech. However, I think the likely scenario is that we get the tariff deadline gets pushed out even further.
Wonderful analysis. That was Crawford Del Pret of IDC. Thank you for joining me. Now, PayPal is trying to boost income from the popular Venmo person-to-person payments app. It will come out with a Venmo credit card in the second half of the year, and Synchrony Financial was chosen as a banking partner after a bidding process. And coming up, CrowdStrike went public in 2019, and one of the companies that helps power its sales was also working with Datadog, Zoom, and more. We'll hear from the CEO of Clary next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Juul is giving into pressure from regulators. It's suspending the sale of most of its e-cigarette flavors in the U.S. Fruit and dessert flavors will no longer be available. Juul took action after a review led by its new CEO, Casey Crosthwaite. Juul designed its e-cigarettes to help longtime smokers switch from combustible cigarettes, but the devices also have hooked a generation of teens and young adults. CrowdStrike, Zoom, and Datadog, besides being three companies that went public in 2019, they also share one thing in common. They all use AI-powered software by Clary to drive revenue operations. Last week, Clary, which was founded in 2012, announced $60 million in Series D funding, bringing their total raise to $135 million. For more, I bring in Clary CEO Andy Byrne and as well Enrique Salem, partner at Bain Capital Ventures Partners, who's invested invested in this latest round. So let me start with you. Congratulations on the funding. What are you using the proceeds for?
Across all areas of the business, first of all, we're super excited for the fundraise. It's two great firms that have joined our portfolio of investors, Sapphire and Madrona. In terms of what we're using the funds for, actually we're going to be investing in not just marketing and sales to drive top-line growth, but also in R&D, because our customers are looking for us to actually expand our value across what they call revenue operations, that business process.
Enrique, with so much focus on driving top-line revenue growth, there is increasing scrutiny on making sure you can at least see that path to profitability. With Clary and some of the other companies in which you're invested, how important is it to at least be able to see the path?
I think today you are seeing public market investors look for profitability, but this is a company that still has such a big market opportunity ahead because every business needs to generate revenue. And so in the short term, our focus is in how do we reach more customers successfully, how do we generate revenue and growth for Clary, and really help companies with what's most important to them, which is revenue operations.
You know, we talk a lot about companies that come on this program. They're all trying to use AI. They're all really coming out with all this latest technology. It is a really crowded space. How do you stand out?
Well, I think we stand out based on our momentum and the value we delivered. So as I think about the value we've delivered to great companies like Zoom, Okta, Qualtrics, you know, what's interesting for me is that these CEOs and boards of these great companies, they are looking at the application of AI across their entire revenue process. And then how can we use that to help them accelerate their revenue and boost the accuracy and predictability of their forecast, because they view revenue, Taylor, not just as an outcome, but as an actual business process that they can streamline and automate, and that's leading to remarkable growth and shareholder value. And it happens that our platform from Clary is underpinning all of this.
We've talked about what a volatile environment it has been as of late. What business model is working for you now?
Yeah, what we're seeing in the marketplace today is companies really need to move to a recurring revenue model. That's what matters, because it has a high level of predictability and it gives you the ability to have lots of visibility into what's going to happen in the future. And investors are always looking for ultimately what generates cash flow. And so what Andy's done from day one, I mean, we've been working with Andy now for 6 years since the beginning, and he's always had the vision on what was the right business model for the company, and that is recurring revenue.
And while you're focused on running the business and the day-to-day operations of that, eventually as you look out, what is the appropriate, not exit strategy, but I'm thinking like an IPO, sort of your end-of-line goal, given that we've learned that not all IPOs are successful right now?
Yeah, I think for us, we're really focused on just growing the value within the customer base. So I have customers that spent $100,000 with me 2 years ago and now are spending $1 million with me this year, right? So I was just with a CEO back in Boston of a company that's a medical device manufacturer, and he was mentioning to me that we've reduced their slip rates on their deals, we've increased their conversion rates, we're accelerating their revenue. So we're really focused on spending around R&D and then making sure that we can help our customers optimize every single revenue moment in what they call the revenue operations process.
And what is your ideal exit strategy?
Look, we are always investing in companies to build big companies that matter. And you know what Andy's done with his team is they're solving a problem that matters to every business. And so for us, it's how do we build ultimately a big public company.
We've also talked a lot about the differences between the direct list and an IPO. We know the differences, if you need to raise money or not. Do you expect, though, that more direct listings continue to take more market share within that IPO market?
When you look at IPOs, and I sit on the board of 4 public companies, you really want the market to decide what is the best pricing for the IPO. And so my expectation is that over the next couple of years, you will start seeing more direct listings. Now, it's not for everybody. You know, high quality names with great brand awareness, a direct listing probably makes a lot of sense. For other companies that maybe need to raise their profile, that might not be as simple a process.
And finally, here in the last 6 months, let's say, what has been the extra focus, the extra attention, not only on profitability, but valuation, corporate governance, all of those things now that are in so much attention?
I think in our market, we look at the focus has been around certain regulations like GDPR, ISO 27001, SOC 2. These are all government regulations that are being applied, so our customers can have confidence that they can deploy AI and not be worried about privacy, we're worried about security. And what that has done is it's actually accelerated the adoption of our revenue operations platform and AI across a myriad of industries.
Wonderful. Andy Byrne of Clary and Bain Capital Ventures, Enrique Salem, thank you both.
Thank you.
Now, Chinese tech giant Huawei has long been a target of the Trump administration's criticism, most recently as the company pushes for 5G technology in the U.S. An interview with Huawei's chief technology officer, that's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Let's get a check on today's top tech calls on the street. Apple received a price target upgrade at Barclays to $224 from $207. The analyst cited slightly better than expected demand for the iPhone 11 and raised his estimate for iPhone unit sales for both 2019 and 2020. And following that upgrade, Apple supplier Cirrus Logic was upgraded to an equal weight from underweight at Barclays. Cirrus will benefit from the release of the 5G version of the iPhone next year. The price target was raised to $55 from what had been a street low of $40 a share. And shares of Limelight Networks surged in Thursday trading after the company reported revenue that beat expectations. Analysts who cover the operator of content delivery networks said that results suggest a growth inflection is underway. And those were today's top tech calls. Now, the Trump administration has made no secret of its hostility to Chinese tech giant Huawei moving into 5G, placing restrictions both on sales into equipment into the U.S. and on sales of components to it by U.S. companies. For the perspective from Huawei's side, Bloomberg's David Weston sat down Thursday with Paul Scanlon. He's the chief technology officer of the Huawei Carrier Business Group.
We work in 172 countries globally. 170 of those administrations we talk to. It would be lovely just to have this type of discussion with the current administration here in the US to understand the rules. What would you like us to do? To explain our company, to describe how can we do business together? If you set the rules and the standards, we follow the law. This is Huawei Technologies in US is a legal entity. It will not do anything against the law. Our board has said that, the CEO, the group CEO, and our founder, Mr. Ren Zhengfei, has said that. We comply with the law in every country. There's no way we will comply with a law that says from China what we must do here or another country. That's outside the law. And that's not what Huawei does, and we will never do those things. So first of all, I'd like to encourage, if we could have constructive discussion with the US to explain how we do things, why we do things, how the company is structured. There's nothing secret about Huawei. Mr. Ren is not a secretive person. He travels to almost every country in the world to meet customers, to meet administrations. We don't do anything that's secret or different. What we do differently is we invest heavily in R&D because we understood 30 years ago, if you don't have your own products, you're just a reseller. Where's your core value? Why we spend so much on R&D? Because we've learnt. Even Mr. Ren's offer of 5G more recently to US companies to say take a snapshot of our product today and put it into a US company and let the US grow and develop. Great idea. We've done this before, Motorola in 2003. It's not something new or mysterious. It's an honest attempt to say, if you tell us what the rule is, then maybe Huawei can understand how to play the way the US would like.
We're talking with Paul Scanlon. He's the CTO of Huawei Business Carrier Group. So Paul, let me just raise this possibility that the problem that the administration has, or some people otherwise in the United States may have, is not with Huawei. It's not saying that Huawei is a bad company, it does bad things. And it's certainly not with the success of Huawei. If anything, it may be the reverse. The people are concerned you're so successful, you will become more dominant or at least have a larger market share. The concern is with Beijing. And you cannot control what Beijing may do to you or may try to get you to do. And I think that's the concern. Doesn't that make your position somewhat more difficult?
I don't agree. I've been in the company 11 years and I don't agree. Okay, so I won't agree with that position at all. What I'll say is our job, our focus, Mr. Ren, the board, every time I meet any of the board members, every time at our annual conference, half-yearly conferences, Mr. Ren is quite clear. Let's talk about market share and competition. Mr. Ren has stated many times you cannot have too much market share. If you take too much market share, what will happen to you? There'll be no, first of all, if there's no competition, especially with Western companies, there's no innovation. The reason this industry is so interesting and exciting, the reason that 5G holds so much promise, is because of the opportunities that it can do, especially to industry. And that's where it can transform things. Could you imagine if everything was connected? All the advances we'd be able to make by pulling data up through the cloud into supercomputers with AI, we would be able to fix things like cancer. We'd be able to fix things like different types of diseases. And they're good things for humanity. So Mr. Wren has always said, you can't take too much market share, number one. Number two, you must provide a healthy ecosystem. Do you know, David, last year we spent more than $11 billion US with American suppliers of components and software and other parts. We would continue to do that if the US would allow us to continue to be part of a global supply chain. So that's what we are.
Paul, well, could I ask just one last quick question, which is put it around the other way. To what extent is the United States risking falling behind in 5G? I know not only in China, but you're also selling a lot into India at this point. Is there a competitive danger?
You know what the US could look, we already build a lot of 4G networks out in rural US. I think everybody's probably heard about this, and maybe we don't talk about it enough or promote it very much, and I'm not sure why that is. But some of the regions in rural US that I've been to, we can deliver, just using 4G, about 650 megabits per second. We can do that today. We have been doing that. Those sorts of things are available. The US moving down the line of deploying 5G over millimetre wave was necessary because of the constraints they have in this thing called C-band spectrum. But the good thing is companies like AT&T, Verizon and T-Mobile, by trying this 5G technology, even if it's with our competitors, you start to learn about where the business opportunities are. Right. We can see by 2025 somewhere around almost $300 billion in GDP improvement globally. Now, what the US is good at, if it was all connected, what the US is great at is pulling that data up. Look at what Google and Amazon and Microsoft and the others do, and applying leading AI. Why not let Huawei come in here and provide the best technology for connectivity and work together with the Trump administration and improve society?
That was Bloomberg's David Weston with Paul Scanlon, Chief Technology Officer of the Huawei Carrier Business Group. And coming up, despite the competition ramping up for Netflix, Wall Street is pretty thrilled with its latest earnings report. We talk about the company's subscription growth next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Shares of Netflix are up the most since January. Third quarter results have allayed investor concerns about competition from Disney and Apple. The online video company added almost 6.8 million subscribers, plus Netflix had stronger growth overseas. To discuss these earnings and preview next week, I'm joined by RBC Capital Markets analyst Mark Mahaney. Mark, a competitor or a friend of yours, I should say, Michael Nathanson of MoffettNathanson, talked about how Netflix is reaching the S-curve in terms of growth. Yeah. Do you see the subscription growth for Netflix starting to slow down a little bit, and does that worry you?
Yeah, it is a concern. I think Michael may be right here. I don't want to give him too much credit, but he may be right. They're going to add up, per their guidance, they're going to add about 2.5 million subscribers this year. Netflix, that's in the U.S., I'm sorry, just in the U.S. The last 5 years, Netflix has added about 5 million subs a year. So when the growth slows down, it tells you that you're pretty far along the S-curve in terms of penetration. Now, you have to caveat with one thing. Netflix did impose a price increase earlier this year, and this was the biggest price increase they've ever implemented because it took their low-end price, $7.99 to $8.99. I think that's the issue for Netflix. Like, I think they overstated or overthought or overestimated how much pricing power they have. It's going to take them a couple of quarters to work through that. I still think they're deep along in the S-curve in the U.S. Plenty of growth opportunities, however, in the overseas.
But they did talk about how some of that price increase was pressuring them a little bit in terms of new subscribers. Does it make sense for them to adopt a lower price ad-supported model, for example?
Possibly. Well, one, I don't think they're going to do it, having asked them this question about a dozen times over the last dozen years. I don't think they have any interest in doing it. Maybe they'll change their mind in the future. Possibly that they could introduce a lower price subscription plan, but I don't think they'll do that. They have a lot of confidence, and maybe it's arrogance, that the content, the quality and the amount of quantity and the quality of the content that they have is enough to justify the $7.99. And frankly, I think it probably is. It's $1 more. Their base price is $1 more than Disney, but you get a lot more content than what Disney offers. So I think it's actually justified. Would it help them to go to a lower price point? Probably, but I don't think they're going to do it.
Would it make sense to buy a Hollywood studio? They're one of the few competitors that aren't in a big blockbuster movie theater. They've said that their content won't be out there. Would they just buy a Hollywood studio and then be able to get that distribution that way?
Possibly. I don't think so. I thought you were going to go the other way, which, Taylor, I thought you were going to talk about whether they would get more into the production side rather than the distribution side. I could see them vertically integrating into production, not so much into distribution. I think they're pretty happy with home distribution. Yeah, I think that's kind of where the growth is. Look, this revolution that we're living in isn't going to be televised. It's going to be streamed. Everybody is going to streaming. Disney, Apple, Time Warner, Comcast. I think Netflix is in the right business. The question is, do they keep executing well to develop good enough content to justify these price points they offer?
So you've brought up all of the competitors.
Yes.
Of those competitors, who is best positioned to take on a company like Netflix?
Only Disney. I don't think Apple is really, unless they really want to put a lot of money into content, which I don't know that they do. And then they also have to come up with a more compelling service. You can't just throw money against this problem and assume you get it right. Netflix has been doing this for a long time. Netflix has 5 times as many subscribers as anybody else. It does give them a scale advantage. And I want to get one thing really clear. The battle here is in international markets. Next year, Netflix is going to roll out 130 new local language series in international markets. I'm talking about the Philippines, Turkey, Nigeria. I mean, everywhere around the world. That's where the sub growth is, and I think Netflix is way ahead of the curve on this. That's their big advantage right now. A lot of problems near term, but that's their big advantage long term.
So you also cover Roku. Is
Yes.
international growth the key to Roku's expansion?
There's 2 things that are key to Roku. One is that it's a great play off of these streaming wars. All of these new streaming services, in order to get subs, they're going to have to advertise somewhere. They're going to advertise on Roku because Roku already has 30 million streaming subs. Secondly, if you start your subscription on Roku, you're going to have to share some of that with Roku going forwards. And then third, anything that leads to diversification of content is beneficial for kind of a Switzerland, which is what Roku is. International is part of the growth strategy, but they barely scratched it. So yes, if they knock the cover off the ball as well in international markets as they've done in the U.S., the stock could triple from here.
I want to switch gears a little bit and talk about Facebook. There's been a lot of rumors this week and talks about Libra, if the cryptocurrency works, if it doesn't. Is Facebook doing the right strategy by going out on these new ventures, or do you think they should just stick to their core business?
I don't know, Taylor. You're asking a good question. Libra, look, they have these wonderful assets. One's Facebook Messenger and one's WhatsApp. These are the 2 most popular messaging applications in the world. And right now they generate about 0 in revenue for the company. So could they monetize it through advertising? They're pretty good at doing that. So they should probably try that first. Could they create a wallet around it? Yes. Does it have to be a crypto financed wallet? I don't know. That was always the question in my mind. Why do we have to go Libra? But I think it's too early to call whether that was the right move or not. That they think about monetizing it through a wallet, I think is a very good idea. As
you assess the earnings landscape, what's your top pick this season?
Well, I think right now it's Facebook going into earnings. And Facebook's the most interesting because I know we just discussed about the Libra issue. The rest of the business, I think, is humming. This company is going to do north of 30% revenue growth this year. I know there's a lot of overhangs on it. I know you're going to ask about regulation. But this stock trades at a discount to its growth rate. You rarely see companies sustainably trade at a discount to the growth rate. In other words, it's 18 times GAAP earnings for like a 25% earnings grower. There'll be an arbitrage there, and the multiple is likely to go up. When it does is hard to know. Sometime in the next 12 to 18 months, I think there's a material re-rating in the stock.
So you're stealing all my good questions by bringing up regulation. So talk to me. What companies do you are trading at a big discount, given that, we talk about a conglomerate discount. Let's say there's a regulation discount. You remove that, what stocks would be poised to see an uptrend?
Well, there's 3 big tech, there's probably 5 big tech companies that regulators and politicians are looking for. In the Democratic debates, only 3 were brought up, I think. Amazon, Facebook, and Google. And probably Facebook is probably most in the crosshairs, and Google too. They're both paying pretty large fines. My guess is that Amazon will be fined too, whether rightly or wrongly. My guess is wrongly, but they probably will be fined too. So all of these three, I think, in some levels, have had their multiples taken down by the market over fear of fundamentals. I'll just make one clear point on this. We've had major regulation in the market. These companies have already been regulated. There was something called GDPR that came out of Europe last year, and it hasn't impacted Facebook or Google's fundamentals. No change in the value proposition of those two businesses to advertisers or consumers. So if that didn't do it, I don't know why new regulation would do it. And I really doubt they'll be broken up. I think it'd be very unfortunate too for consumers. So I hope they don't get broken up. I think it's unlikely they get broken up too. In that case, there is this mismatch, and you want to buy the strongest assets when they're quote unquote on sale.
All tech, all the time. That is Mark Mahaney of RBC Capital. Thanks for joining me.
Thanks, Taylor.
And coming up, Zuckerberg speaks out. We look at whether he brought new solutions to fighting online hate speech or if he just played back Facebook's greatest hits. That's next. This is Bloomberg. Facebook CEO Mark Zuckerberg gave a speech on the social network's take on online free speech at Georgetown University. And we heard a lot of Facebook's already laid out defenses.
More people across the spectrum believe that achieving the political outcomes that they think matter is more important than every person having a voice and being heard. And I think that that's dangerous. And I understand the concerns that people have about how tech platforms have centralized power. But I actually believe that the much bigger story is how much these platforms have decentralized power by putting it directly into people's hands. We've actually found that a different strategy works best. And that is focusing on the authenticity of the speaker rather than trying to judge the content itself. And while I certainly worry about an erosion of truth, I don't think most people want to live in a world where you can only post things that tech companies judge to be 100% true.
For more, I want to go to Bloomberg's Kurt Wagner, who was at the event in Washington. Kurt, what are your key takeaways?
Well, you kind of heard a few of them there. You have a CEO who's currently dealing with like 4 antitrust organizations talking about decentralized power and how his platform is actually good for people. He talked about the power of being able to reach the masses, kind of this power of scale as being the fifth estate, actually, is what he was talking about today. And so, overall, there were a lot of talking points from Facebook that we had heard before, but I think some of the keys were, we are actually doing a good thing here by giving people a voice. We are, supporting politicians by not pulling down their ads and being worried about the accuracy of political ads. And then he also kind of brought up this threat of China, which is something he's done before, and really just said, if we don't do this, China might come in and take over, and they don't have the same beliefs that we do, and that's a real threat.
Before we get to China, I want to hit on the first point that you made about sort of Facebook not wanting to be in the fact-checking business. What is their defense for not wanting to do that?
Yeah, so you kind of heard him talk about it there. He says that no one really wants to have a tech company be deciding what should be true and what should be false and what should be allowed on the internet and what shouldn't. And this has been a debate around Facebook for a really long time. What is the company's role in dictating, what exists online? And so part of his argument there was that if we are the ones who are fact-checking political ads, or if we get rid of political ads altogether, which is actually something I wrote about this week, I think Facebook should consider doing. He says that is actually going to benefit the incumbents, because suddenly the people who already have a platform, who already have attention from the media, those are the only people who are going to get talked about, not the people who are willing to pay to kind of make their way onto the scene. So those are a couple of his arguments for why he thinks not only should political ads should stay on Facebook, but why he thinks they shouldn't be meddling with them.
Bloomberg's Kurt Wagner, thanks for joining me. Now, for more on the subject of free speech online, I want to welcome a journalist who's been covering this topic extensively. It's Andrew Morans. He's a staff writer at The New Yorker and has just published this. It's a new book on the subject called Antisocial: Online Extremists, Techno-Utopians, and the Hijacking of the American Conversation. Since we have you here, talk to me about the Zuckerberg speech today, not wanting to be in the fact-checking business. Isn't that right, though? We don't want tech companies telling us what is or is not news.
Yeah, I think this is a perfect encapsulation of how misleading a lot of these talking points are when it comes from the people who built these systems, because, you know, he wants to make it seem like this is just a neutral public square and that he is just someone who wants to let freedom of expression reign and not be a gatekeeper. That's fine, but he is a gatekeeper. Facebook makes decisions about how their algorithms work every day. They make decisions about what you see in your feed and what you don't. So it's just disingenuous to suggest that this thing that he built is not already putting a finger on the scale. You know, it reminds me of someone who built a big highway system and then says, well, we like freedom of enterprise, we like cars, we don't want to deal with the fact that pollution is killing our environment. Well, sorry, you built a system, it's having consequences, you have to clean it up.
And if that is the case to be made of why there have been increasing calls for Facebook to be treated like a publisher or even a utility company with more regulation.
Yeah, something has to be done. Look, I mean, it reminds me of starting a big warehouse party. This is an example I use in the book, an analogy. You know, you start a big party, you hope everybody's going to have fun and just get along. But if you don't build in a sprinkler system and people start setting things on fire, you don't have any way of policing things or controlling things when things get out of control. You know, you can't just hope and pray that progress will keep going and there will be some arc of history that will deliver us to a better result. Facebook has been used to spark genocide in various countries. It has been used to spread autocracy throughout the world. So it's nice to rest on the abstractions of free speech, but abstractions are not going to get us very far. It's too late for that.
We heard from Mark Benioff as well this week, making calls for Facebook to be broken up. But does that actually solve the problem?
No, it doesn't solve the problem. I think the problem is deeper than that. The reason I wrote a book called Antisocial is not because it's just anti-social media. It's because there's this feeling that all of the internet would be pro-social, in the sense that it would bring us together, it would make the world a better place. That was the first 10 years that was all about what would be pro-social about social media. There was always an antisocial side. There were always people inciting violence. There was always harassment. There was always bigotry. We just didn't want to think about that. We didn't want to look at it. We wanted to think about the Arab Spring and democracy and all the fun stuff about the internet. But if we don't look at the harm that can be caused, we're just kidding ourselves. We're just leaving out half of the story.
So you brought up the book. You were on the road conducting dozens of interviews. What was the biggest thing that you learned?
In addition to interviews, I was just a fly on the wall as these people, trolls, propagandists, misogynists, bigots, as their kind of mask would slip. So I was in the room, you know, I was in the room with a guy in Orange County, California, who was just a average married guy in his 40s, not some teenage troll in his mother's basement. You know, a married guy with kids and a dog. He would wake up in the morning and he would say, I want to create a subliminal association between a political candidate I don't like and disease and disgust. And even though he didn't have evidence to do that, he would just do it. I would watch him just open Periscope, rally a bunch of his followers, get a Periscope hashtag, get that hashtag trending on Twitter, and then from there it would just enter the national discourse, to the point that I would wake up the next morning and read the newspaper, and this guy's fingerprints would be all over the news. And trust me, this is not a guy that we want with our fingerprints all over the national news.
So you fold this into what you've observed into action. Not only did you write a book, but you had an op-ed recently which said one thing they could do is replace Sheryl Sandberg with a human rights lawyer, someone who can teach us how speech can lead to violence. Why Sheryl Sandberg?
I think that from all we've heard, she seems to be the person who is most promoting profit at all costs in that company. Most of the reporting that's come out of there has said that she was the one who set up the advertising model. She's the one who's been really uncompromising about kind of full steam ahead with anything that gets in the way of profit, you know, sort of being eliminated. And some things that get in the way of profit are just necessary for our survival. Like making sure that these platforms don't spark genocides, making sure they don't spark violence, making sure people don't get killed because of these platforms.
Well, let me push back a little bit, because to their defense, they wanted to create a platform in which there was public discourse. There was room for us to have these multiple conversations and discussions. Why is it then on their burden to then be able to regulate what is or is not said?
Because they built the room in which we're having this party. If you're hosting a party and you don't card people before they come in, and you don't decide that any behavior is out of bounds for the first 10 years, and things start going haywire, it's your party. You might not be doing everything that everyone's doing, but you're the host. You're responsible for what happens in that room.
So what regulation then is the right answer? Because it's not all regulation is good. Like you've said, breaking up these companies wouldn't necessarily solve the underlying problem. So what type of regulation would you see as a good response?
I don't think the government can do it on its own. I think some government things could be useful, analogous to GDPR. Some antitrust stuff, but I think a lot of it is going to have to happen from the companies themselves and from us, the users, to really create a public movement to push back and say there are boundaries. With any industry, we can talk about freedom of speech, we can talk about freedom of enterprise, but if you're trying to get kids addicted to cigarettes or you're trying to get people addicted to gambling, we as a society have decided that there are limits.
I want to switch over quickly because we talked a lot about Facebook and there was Twitter, and during the Democratic debate, a lot of the senators said we should delete Trump's Twitter account. Twitter then came out and said world leaders aren't above all of our policies. What is the case to be made that someone's Twitter account should or should not be deleted? Frankly, the president's.
Yeah, the case to delete the president's Twitter account is pretty easy. He violates their terms of service repeatedly.
Twitter has said that he doesn't necessarily violate them.
They've said that there's a newsworthiness exception, but they have a rule against threats, and when you threaten nuclear war, that is a threat.
Andrew Morans, author of Antisocial, thank you so much for joining me. And still ahead, competition between Slack and Microsoft heats up. We talked to Brian Elliott, Slack's VP of Platform, on its plans to take on the tech giant next. This is Bloomberg. It's been a busy few months for Slack. This week, the company announced the launch of Workflow Builder. It's a new product to help users cut the work out of work. This comes just a few months after direct listing on the New York Stock Exchange. Since then, competition has been heating up with Microsoft. To discuss all of this, I bring in Brian Elliott, Slack VP of Platform. So first, talking about Workflow Builder to help us be more productive. How does it do that?
So Slack built Workflow Builder to help make people's working lives simpler, more pleasant, more productive, like everything else we do. Workflow Builder is a no-code tool. It's a visual tool that allows any user to automate routine tasks. So let me give you an example. Everybody has the joy of introducing somebody new to their team. You need to get them to talk to the right people, share the right documents, fill out the right forms. Poshmark, one of our customers, was actually a pilot customer, built a workflow using Workflow Builder that automates that process, takes the work out of it, helps people focus on their everyday job. That's what we're really about more broadly. We bring alignment and productivity to teams by helping them get work done more easily.
So you came out with a blog post last week that highlighted the daily active users, 12 million on Slack, Microsoft Teams, 13 million, but you guys are making rapid advancement. How has that competition been?
So the competition is based on the value that Slack actually brings to its customers. Microsoft itself is a highly successful company. They've done a great job building out the Office 365 franchise. It's got 100 million users in it. Teams has been available for free for a few years to those people. They're also deprecating Skype for Business and pushing people into Teams. 13 million is a good number, but I'm not sure it's a big success in that context. Slack, people pay for it because they see the value in it. 12 million daily active users, 6 million of them paid. People have Slack open on their desktop or on their phone for 9 hours a day. They're using it for 90 minutes of that. 5 billion actions a week. 5 billion actions a week taken by people means people are reading messages, writing messages, they're doing searches, they're sharing documents. And I run the platform team, which integrates all the tools people use. 5 billion actions means that people are integrating and using the tools they need every day in Slack. That's why we're seeing real value in Slack, and that's why companies pay for it.
Well, when you talk about companies pay for it, I think the big success story about Slack has been those enterprise clients, customers. Those are pulling in more than $100,000 in revenue, and you want more of those big clients.
That's right.
How does Workflow Builder get us to get more of those types of clients?
So Workflow Builder is a great example of how we help companies actually deliver on the needs they've asked us for. Teams engage deeply in Slack, and in fact, those large enterprise customers are the ones that asked me to help us get the Workflow Builder built. Let me give you an example. There are 500,000 custom applications that get used in Slack every week. These are internal jobs that somebody has built that might be the purchase order approval process or new employee onboarding. Up until Workflow Builder, though, you had to have a developer to build one of those. Workflow Builder allows anybody in a company to automate those kind of routine jobs. Every large enterprise customer is short on developers. Workflow Builder addresses a real need to help companies collaborate more efficiently and more productively, including in really large enterprises.
So finally here, I know you're running the platform side of the business. We've talked a lot about the differences between the direct listing and the IPO. Generally speaking, since going public, how has it been like? Has there been more scrutiny on the business?
So we're focused on delivering value to customers. It's been the focus since when I joined Slack a couple of years ago. That's one of the things that we're the most proud of. Our focus is on how do we deliver value to customers. That was true before we went public, it's true after we went public, and it'll continue to be true.
Okay, that is Slack VP of Platform, Brian Elliott. Thank you so much for joining me.
Thank you.
And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.